So floating interest rate have just hit 7%. Does property still make sense? Would you even invest in anything? What's going on, everybody? It's Blandon here from Mortgage HQ, and in this video we are going to try make sense of three things. First one is what strategy still makes sense right now, and secondly, what numbers make sense, and thirdly, what cities or regions make sense right now. So one of the most common question is, man, prices are dropping right now, Blandon, and interest rates gone up. Shouldn't we just wait longer? Well, I'd like to share two principles with you, and these are foundational strategy tips that you can apply in any given market. Whether it's going up or down, as long as you stick with these two principles, you'll be sure to make money on properties. So the first concept I'd like to share with you is called the margin of safety. This is actually made famous by Warren Buffett, and it's a principle that was taught by his mentor Benjamin Graham. Essentially, what he's trying to say is that everything has a market value. And if you can calculate exactly what that market value is and you can buy something at a discount, you've built in what we call a margin of safety. So just as an example, we're in this market where prices have probably dropped more than 10%. Let's just say around 15%. And that is today's market price. Now, you can go out there and make 100 offers on properties. That's 10% below what the market price is. So this is your margin of safety if one of those offers gets accepted. And because of this, the worst case scenario is that if market dropped another 10%, you're at worst break even. So that is why margin of safety is such an important strategy. And it all comes down to understanding certain suburbs and markets. And we have another video in the channel that talks about how you can buy properties under value, and you can do your comparative market analysis using some tools. Now, the second metric or principle that you need to understand, which is relevant to a property strategy, is called the cash on cash return. Now, simply put, this is the rate of return on the cash that you're putting into the deal. Now, I understand sometimes when you buy properties, you put 100% finance up on the deal. But it is important to always look at your opportunity cost. So you would assume that your equity that you put in could be deployed somewhere else. You could put that equity somewhere else. You could use that equity in another property, and that is your opportunity cost. So you can calculate how much return you're getting on that particular equity that you're using up. So what does cash on cash return communicate? Well, simply put, whatever you're putting up, okay, you want to know how much money you're getting back on day one. This is contrary to what we always preach about, which is the capital gains. Because in an environment where interest rate is high, you want to look at the immediate cash flow. You want to look at the positive outcome from your investment. So I'm going to show you a few examples here. The first property we have is a existing unit that perhaps you buy for $600,000, and you're going to put down what we call an opportunity cost of 20% equity. Now, the loan interest rate, say, is 6.5%. Now, even though you might be borrowing 100% finance for this property, we're still going to use a opportunity cost of 20% deposit. So now you can see a unit might get you around $550 rent because it's 2-bedroom. You've got 1% vacancy rate, insurance rates, etc. You can see that the cash flow, if it's 0% tax deductible, you can see that the cash flow is actually $21,000. Now, because we don't have tax deductibility on the interest, you can see that it ends up to be negative cash flow. If we look back 2 years, 4.77% is pretty good, but right now it puts you in a negative cash flow position. And so because you put in 20% cash, your cash on cash return is just negative $16,000 divided by the 20% deposit that you have put in, which is a negative cash flow of 14%. So the next natural question is, well, what about new builds? Because you have interest deductibility, would it be a better choice? So let's say a new build for $600,000, same opportunity cost of 20% deposit. Now we're going to look at a higher rent because it's brand new, $580 rent, and then we assume all the expenses are the same, except for the fact that interest tax deductibility is at 100%. So now we're negative cash flow of 8,400. So with a higher gross yield, you're still looking at a negative cash flow of minus 7%. It's not too bad if you can assume that there is capital gains in the future. Now let's look at a third property. This is something that I bought recently, and it's a multi-unit in Martin. Now I actually bought it for lower than 600,000. If I spend all the renovations, it might be 575, but I'm just going to use a round figure to compare with this existing unit and new build. So what this property essentially is 4 units on one title. We're going to use an opportunity cost of 20%. The rental income is $1,280. This is the bottom of the rental appraisal. Currently, it is only getting $700. It's severely under rented. But if I bring it back to Healthy Homes and renovate it, I'm going to be able to get the bottom of the rental appraisal as a minimum. So the biggest difference in this deal and the other two that I've shown you, I've highlighted here in red. Basically the insurance and the rates a lot more, and also the maintenance cost is going to be a bit more as well. So I don't have interest tax deductibility because this is an existing property, and so you can see that in position we have a negative cash flow of $400. But what am I getting in return for this old property? Well, it is on a much bigger section, over 1,000 square meter. This is north of Palmerston North. And as you can see, it's a nice weatherboard property, and the rental appraisal here, as you can see, will add up to $1,280 on the lower end. But what's the upside with this type of property? Well, there are a lot of regions that severely lack social housing. So this one, we managed to look at a social housing contract, and we would get at least the bottom of the rental appraisal for our rent, and we also have 0% vacancy. Now because of that, the only thing that changed here is the 100% tax deductibility, and as you can see, because of that, we have a income of $10,000 at the end of the year. So gross yield still stays the same at 11%, but now you look at cash on cash return is at 8.55%. That means the 20% deposit that I'm putting in this deal, I am getting 8.55% cash flow. This is before my capital gains. So you got to ask yourself a question: where can you park your money that is giving you 8.55% cash flow return? And so that means for this particular exercise, this is a very good investment for me. What this also tells us is that the numbers that you should be looking for in this current market likely need to sit around that 9 to 11% gross yield. Because in this particular property, the reason why the cash flow is not higher is the rates and the insurance is much higher because it is a multi-unit. But if you could buy maybe something that has dual income or tri-income, then perhaps the rates might be lower, bumping up your overall cash flow. So what else could you buy that sort of sits around those 9%, 10% mark? Well, this is my colleague's property that he just went unconditional on. Some of you might have talked to him. His name is Ziyang, who was the top 4 advisor last year. And this property is in Gisborne. It's a 4-bedroom on a 700 square meter piece of land. And as you can see, it is pretty old, but social housing was happy to take it as it is with just a bit of a cleanup. And what Ziyang's going to do, because this property starts at 9%, he is adding a sleep out, and the social housing is more than happy to take that on board and give him extra rent, making this property, including the cost, close to 10% gross yield. Again, it's cash flow positive with a good cash on cash return. And so you might be asking, Blandon, where do I find these property? Well, have a quick look at this one here. This is on the market right now at the time when I'm showing you guys this video, but maybe by the time it's online, you won't see this anymore because this is something that we are currently looking at. This is in Otaki, which is in Kapitiki Coast, north of Upper Hutt and south of Levin. It's a very good location because it's quite close to the coast, and as you can see, this has got 6 income streams. Currently renting at $14.50 a week, and it's asking for $9.25. But this property has potential to achieve 9% gross yield just based on the rental appraisal. And because in this area social housing is in high demand, this property could potentially hit above 10% mark. Again, making it a cash flow positive property with a positive cash on cash return. So that leads us to the third segment of this video, which is what regions make sense. Well, there's a common misconception that Auckland and big cities like Christchurch, Wellington are the only cities that you can get capital gains on. So if you look at the capital gains in Auckland in the last 5 years going on qv.co.nz, you can see median prices 1270 and it's now sitting at 1500. So that tells us is around 20% overall gains in the median in the last 5 years. Now, if you just went to Martin, for example, which has, by the way, the biggest drop in this particular district, you can see it's minus 11%, which means that is the market price. And because if you add a margin of safety into the purchase price, then you could potentially buy something at a much higher yield or a significantly discount on the purchase price as well. But even in the last 5 years, you can see that the median price was at around 200 and now it's sitting at 444, which means there's over 100% in value gained, significantly higher than Auckland. Now let's just have a look at Gisborne, for example. Prices sitting at 300,000 5 years ago and now it's sitting at 600. Now, there might be argument that Gisborne is overpriced right now. That could potentially be true, but again, if you go back to your principles, which is your margin of safety, which is buying, which is first understanding what the market price is, and could you buy properties at a discount? And secondly, what sort of returns are you locking in? And Ziyang's property has demonstrated that if you buy with a discounted price and lock in at a strong cash flow, you've already locked in your return on cash and also the future equity. And Kapiti Coast, if you have a quick look, we are looking at 538 and then now it's sitting at around 880, which is over 60% gains over last 5 years as well. So there you have it, folks. I hope you found that helpful and not let the 7% scare you, because if you stick with the basic fundamentals of property investing, you can make money in any market, and there is no better time to buy now because you have heard it from everyone else. It's a buyer's market and it's more likely that you can build in a strong margin of safety. It's not about the property strategy, it's looking at the principles. First one being margin of safety, buying properties at a discount by understanding what the market value is. Secondly, you want to look at cash on cash return, which is looking at the return on your deposit or the money that you put into the deal and see what sort of cash flow you can lock in. Now, the second principle that you need to understand is just breaking down the cash flow on the property and see what makes sense so that you can calculate those cash on cash returns. And then thirdly, don't just stick your head into the ground and be ignorant about the fact that other cities also have good capital gains. Take the time to do the research, go on qv.co.nz, go on CoreLogic, download, buy some data and understand how the market works and what has happened historically. Now, if you guys want to learn more, check out our masterclass on our website. And as always, if you just want a strategy session with one of our advisors, reach out. You can go on our website and just book in a 10-minute call and our team will set you up for a session with an advisor. And as always, if you found value, please smash the like button for the YouTube algorithm and we would really appreciate it. And so until next time, I'll see you guys in the next video.